Because it's such an important issue to everyone in the state of Florida. This is when the meeting should have been packed, so you guys can all hear from the horse's mouth. And remember that he is only the messenger, okay? He writes the policies for us. He does not insure us. So this is Damian McFadden. He has been our insurance agent at Monterey for, I would say, probably the last 17 years. He's going to do a little bit about himself, explain some things that are going on in the state of Florida, and then take questions. So we are on YouTube again, so I'll walk around to you guys so you don't have to get up if you got a question you want to ask. All right? Take it away, Damian.
Thank you, Chris. Thank you, Chris. So this is on, Chris?
That's on.
Great. I had one of these last night down in Margate with about 500 people. So anyways, hopefully I have a voice left. These are long weeks in the insurance business. My name is Damian McFadden. I'm with USI Insurance. We're arguably the top broker in the state, just doing condo associations all day long on both coasts. I've been doing this since I was 21. I just turned 50 on the October 29th. I've known Chris for mountains of time, so I have no hair left. Chris has a full head of hair, which is still going good. So God bless him. So I do this all day, every day. I do 5 or 6 Zooms a day, no lie, and now getting out in the field again. So just doing renewals all day long and explaining the market. This is probably the most intense budget season next to last year in the history of insurance in the last 45 years in Florida. So you're not in the minority of boards trying to crunch numbers, trying to figure this out. Budgets, historically speaking, insurance is always 20 to 30% of an operating budget for the last 40 plus years. If you looked at a graph, that's obviously stretching, pushing over 30%, which is what's really hurting a lot of associations trying to figure this out. It started with Hurricane Irma. It then dovetailed in the Champlain Tower collapse, which was like a Cat 5 hurricane, and then Ian finished just off. That's why we're in this hardship. We got a triple whammy the last 5 or 6 years that the insurance market is trying to absorb. You're seeing a lot of homeowners markets flee. And it's an important distinction when you read articles in the paper. Mostly it's trending for homeowners policies. They don't talk about commercial policies very limitedly, except just hardship in terms of what membership is dealing with in terms of dues increasing. There's not one board that hasn't special assessed for insurance in South Florida especially. So that's just been the common norm. Having said that, we went to a situation where we had about 10 insurance companies out there. Again, we're the broker. We represent you in the marketplace as the big bat, so to speak, and we try to get outside the box, inside the box. Any way we can skin the cat, so to speak, is what we're trying to present to you with the bow on it. We had several insurance companies over the last 5 years that were actively writing that pulled out. A lot of these insurance companies are looking at building dynamics and full-scale underwriting with all these hurricane claims. And just so you know, what's really tough about Florida is the amount of claim litigation. And that's why DeSantis signed these measures to basically stop suing insurance companies and reduce the legal incentive to stop doing that. That's what he signed, basically. If you were here after Hurricane Wilma, and some of you here were probably in 04, 05, right, with Gene, Charlie, Francis, Wilma, those hurricanes, it was a different dynamic. Citizens was the vogue market. Back then, the Citizens rates dropped. So when the market after Hurricane Wilma went up 2.5 times, it dropped back down quickly because Chris at the time did a 3-year Citizens rate freeze and said, come on in, we'll let the market figure itself out. Not to talk politics, but that worked. The market figured itself out pretty damn quickly, and we moved on from that. New companies were generated, and for the Citizens wrote policies for about 3 years and was pretty much depopulated after 36 months again. So history repeats itself, right? So right now we're in a vortex of associations trying to get into Citizens again. The Citizens rate is not it's necessarily cheap. It's up as well. They just announced a 28% increase, Citizens October 1st. So it's not like they're giving it away like they did in 05 or 06, so to speak. But we're at 2.5 times normal rates right now. So just so you understand that. What I mean by that is we're basically insuring $60 million here. This footprint is $60 million. This property is appraised every 36 months to come up with that number, to conform to condominium statute, lenders, and your bylaws. So we're always making sure everything at I and T is dotted. The problem is, typically speaking, historically speaking, if you had a $60 million complex, you'd spend about $300,000 a year for property coverage, 50 cents on the dollar. be about $5,000 per million. That's the historical average. We're 2.5, 3.5 times that. And that's what what membership is trying to figure out on these budgets. So we're insured well. We got A+ markets. We're doing everything we can. The average common area assessment for insurance on a village model like this is about $2,500 a door for property insurance. Anywhere you get in your car and drive around to different villages, it's right around that $2,000 to $3,000 pocket, okay? You're right around $2,600 a door for property insurance per year per unit. I know that used to be $500 or $800 a year per unit. We understand that. But that's where we're at. So to live here, you're going to spend about $2,600 a year for property insurance, and then you're going to make your own business decisions on your interior. Remember, we're covering up to the paint inside your unit. That's the condominium statute in Florida. I'm going to give Chris a cheat sheet, and Grace, so you can put it on your website. So you can see owner versus the association, because some of you that bought in here, moved down from different states, don't understand the condominium statute in Florida. The association master policy is appraised for everything up to the paint inside the unit. That's where we come up with the 60-some-odd million dollars. Okay, you're not in a flood zone here. I'm sorry, I'm speaking fast, I apologize. Up to the paint inside your unit.
So everything in the walls
Is the association to insure. To insure.
so that's plumbing,
Yeah, everything inside the wall cavities. God forbid there's a fire, hurricane, compromising of pipes. Obviously, that's a hot button. A lot of old cast iron pipes in buildings. But the bottom line is everything in the wall cavities we have to insure. Not necessarily maintain as an association, but we have to insure it from a peril. So the cabinets, the appliances, the electrical fixtures, the wall floors and ceiling coverings, meaning paint, tile floor, wood floor, etc., is the homeowner's policy. That's called an HO6 condominium unit owner policy. And again, you're going to get a cheat sheet on your website so you can refer to it.
okay. All right, I think I understand, I think.
Yeah, it takes a little bit to get your arms around that. But the drywall is the association, okay?
So if there
Yes.
was something wrong with my plumbing, like I wasn't here and something happened?
Right.
Who's responsible, my insurance or the condominium's
Well,
insurance?
okay, so it's a limited common element, probably because that piping could serve your unit, but the paint in, so let's say there's a pipe break in the wall cavity, you have some cabinet damage per se, there's some drywall damage, you're trying to knock it around with Chris what to do here, and these situations develop over the years as some of this plumbing gets older and older and older, but you have to file an interior claim with your homeowner's company. Because the cabinets are as the unit owner. I'm sorry, it's the unit owner's responsibility, meaning the
Right.
association has no insurable interest inside your unit,
Okay,
regardless of the cause of loss. So you have to file a claim with your homeowner's carrier. They could subrogate, it's called, not to get too technical. Your interior carrier may say, we think the association could be liable here. They may subrogate, which drives managers nuts because we acted in good faith. But they may try to do that. But the genesis of your question is you have to file an interior claim for your cabinets, your appliances, your countertops, your wall floors and ceiling coverings. That's your interior, your contents, obviously, your furniture, your chairs. That's all
Yeah,
your
I got that
personal,
part,
that's
yeah.
all your personal policy. That's called an HO6 policy.
okay.
So maybe just to clarify it a little better, so if you had a plumbing leak, the association would come in, we would fix the plumbing leak, and we would fix all your drywall. Anything else in your unit that got damaged would be up to you.
So how about if it went downstairs to my?
We would fix their drywall only. Correct. They would either have to put a claim in, or if it was something that you caused, they could sue you. Yeah, yeah. But if it was behind the wall, we would fix all their drywall. They would have to put a claim in themselves for any of their personal stuff, which, like Damien said, includes your cabinets, tiling, carpet, paint, things like that. We would put the walls back together.
Yeah, thank you, Chris. You said that better than I did, so I appreciate it. So that's the genesis. I'd be love to answer any of your questions. The market obviously is difficult right now. We think probably we're in one more year of pain next year, and that's what we've been told by the marketplace. I think up here in Stewart area will be much calmer, obviously, than Palm Beach, Broward, and Dade. Palm Beach, Broward, and Dade are the toughest counties in the United States for insurance, for sure.
So I'm going to start the questions then.
Sure.
How many companies are writing policies right now?
So realistically speaking, Chris, four.
4 companies, and
Four
one of them
companies.
is Citizens.
One of them is Citizens.
Okay.
American Coastal, Heritage, Lloyd's of London programs like we have, and Citizens.
How many policies about do you do in a year
Yeah,
yourself?
I'm arguably the top 2 brokers personally in the state. I do about 500 associations year in, year out. That's
Okay.
all that's on both coasts.
So we've added 35% for our property insurance.
Correct.
How do you feel that's going to be for us?
That number's going to be fine. That number's going to be fine. We got through hurricane season relatively unscathed. That was the big question mark when you did your budget, because we were in the middle of hurricane season.
Correct.
We're obviously on the tail end, right? So I think we're definitely going to be below that number, below or near, hopefully less, but we won't be higher.
Excellent. So anybody has a question, just put your hand up and I'll come over with the mic.
So we haven't been informed of this yet, but I saw in the news that our personal insurance company is pulling out of the state of
Right.
Florida.
Very common.
And then our renewal will be this coming spring. Do you have any tips for us condo owners when
Great.
we're out looking for a new policy?
Great question, because we're getting it frequently. It happened to me as well, so down in Palm Beach County. So I definitely share amongst yourselves, because what you can happen is you can call Allstate or Castle Key, and they may say we could write 7 accounts in your zip code. We just became open. The good news, I think, is these markets are going to start to open back up after 11/30, after hurricane season. They're going to start to open up, especially in the spring of '24, in my opinion, because you're seeing articles in the paper and some new companies I've never even heard of in the homeowner space starting to pop up. So call 2 or 3 agents in your local area here. You know, an Allstate agent, a State Farm agent even, a Brightway, somebody that can hit the entire market. We do it as well, but I think it's always good to be, you know, we're up here as well in different pockets in Vero, et cetera, but, which is north, obviously, but your local guys or local people around here, because they get allocated a certain amount of policies they can write, you want to kind of knock on those doors. I would wait till the spring for sure. Everybody's still clinched right now in the insurance world. Let it relax, let it marinate. As soon as it hits 12/1, people start to talk to you.
Yeah, remember that hurricane season is over in 13 days.
Right. Because we're getting it on the commercial side. Some markets are like, okay, we could take some policies between now and the end of the year in December, major high rises. So nothing stays the same in Florida with this. It's always changes. In my 28 years, it's always changes every 3 to 6 months.
What can we do here, in your opinion, to maybe get our insurance a little bit lower?
It's a great question. So you have a steady, you tackle your roofs. You've had a scheduling of your roof, which you're doing all you can on your roofs, which is great. There's been no issues there. You're not in a bad county in terms of insurance. Like if we put this association in let's say, Boca Raton, Florida, it would be double.
Correct.
So you're in a good county. You're not on the water, right? So you're not a major high-rise. There's a big difference in rate if a building goes over 10 million versus under 10 million in valuation. You're under 10 million, which is good. Really, we just need the market to conform, to be quite honest with you. The rubber band is fully stretched. Unless you want to put an impact glass in all your units to save 20% and spend 20 grand a unit to do that. That is short of that, there's nothing you can do.
And wind mitigation.
Right,
We
that-
have that.
Yeah,
And
fully,
we've
yeah,
inspected that, and we have the forms. And
We have all the
inspect-
mitigation forms. Chris and I have been keeping up that for years. Roof inspection reports, permits, everything's been relayed to carriers. Your appraisal, obviously, loss history, everything's up to snuff.
Okay.
Hi there.
Hi.
So I do have a couple of questions. Our current carrier is Lloyd's of London,
Yeah, you're with the SRU syndicate, yes.
and they're an admitted company, right?
No.
Of course. No?
Lloyd's of London, Berkshire Hathaway, Chubb, Zurich, they're all non-admitted in Florida. They don't want to file the rates in every 50 states. So they're actually called non-admitted markets. We're not worried about insolvencies of Lloyd's of London or a Zurich or a Travelers. These companies have formed non-admitted divisions in Florida to do business, and that's very common.
Okay, so that doesn't have a negative impact on us at all?
0.
Okay, so The roofs have been done in stages.
Correct.
Roofs are currently being done, but they're just being covered again. Is that correct?
I'm not, I'm not detailing.
Well, they do the roofs, there's no dumpster with materials being removed from the roofs.
Right.
I think we're allowed to cover our roofs one time in the state of Florida. Like, imagine you have a house with shingles on it, and then you can replace go over those
Yeah.
shingles one time.
As long as it's, yes, obviously they have underlayments and things of that nature, but the mitigation reports reflect those variables. But as long as it's permitted is what we're concerned about, just to relay to the insurance company. And obviously, hopefully meet some sort of code definition in your county or city or township, but the roofing issue hasn't been an issue.
Okay. All right, so I know you help us with putting our budget together as our agent, and I appreciate
Correct.
that. In 2022, the insurance was $563,000. The 2023 proposed budget, it was put down as $712,000, 24.68% increase. Actual figure was $1,346,000. That was a 139% increase.
Right.
Okay? 2024 proposed budget is $1,817,000. So that's kind of a little more normal. But my question is, what other mitigating factors besides Hurricane Ian are causing my YCC rates to rise more than similar properties? Is it our reserves? Our roofs seem to be fine. Any other infrastructure? That we have property on the water at the
Right.
yacht club?
Yeah, that graph you're talking about, since that Hurricane Irma started this show, where things were just, and everybody's been out of budget the last 3 years. So if you take any association, major association, when I say major, over 50 million, and you look at this graph, it's very similar to what you're saying, doing this all day, every day. There's nothing you can do from a mitigation standpoint, like I told the other resident next to you, that you could do to improve this. Hurricane Ian and the Champlain Tower collapse was definitely a huge bomb that hit the market, especially on older structures. A lot of these insurance companies, they don't want to write you unless you're Miami-Dade code, which is 2002 or newer construction. So because of the Champlain Tower, obviously you're 2 stories, it's not relevant to you guys, but just from an age moniker, these reinsurers that are in London and Bermuda start to pull away from older associations. They will start to come back in because they're getting a healthy rate to do that. And your county is definitely going to be preferable. But, we've never had these rates in, history.
Well, my last question is,
But Ian was a huge, we were trying to, not to interrupt you, we were starting to recover from the Irma was tailing off from all the 5 years of litigation. And obviously from a mid-rise standpoint, we can absorb the Champlain event because you're not in that vacuum anyways. But Hurricane Ian at 60 billion plus, if you go over to Fort Myers right now, I do 9 of the buildings downtown, it's still desolate. It's going to be a $60 billion situation. So the market just can't absorb it. It's trying to.
okay, so my question is, you mentioned that in October, Citizens went up 21%?
28% for
28%.
for high rises, for high
Now,
rises.
going from 1,346,000 to 1,817,000, that's a little more than 21%, right?
Right.
Okay?
Right.
Now, why are we not being insured
It's
with
20
Citizens?
Citizens they don't like roofs older than 15 years.
But you said our roofs are fine.
They're fine per se, but the 2006 and 7, based on roof inspection reports, we're navigating that in terms of redoing those for the next, we're going to try every year. We did try, we got kicked out this year. I think it was more the fact that Citizens was trying to figure out their underwriting per se. It wasn't just all about the roof data, okay? So, but yes, going forward, you just spoke to Chris, you have some coming up in 24 and then 25. I do think we got an excellent shot to try to get back in next year with Citizens, but Citizens rates up 28%, not 21%.
Oh, so 28%. Okay,
Yeah.
I understand that.
Yeah.
But the thing that I think people here might not understand is that Citizens is for Florida, correct?
Yeah, it's a non-for-profit in Florida via
Florida.
up in Tallahassee.
Lloyd's of London also covers Texas, who got hurricanes.
It covers
Louisiana.
covers the entire
They took a
world.
beating on all this weather, all over the country. So the thing about Citizens that is beneficial to us is that it's limited to what's happening in Florida. We don't have to get charged for what cars that get flooded in Texas.
Yeah, here's the problem. Lloyd's has about 80 billion in surplus. Citizens has about 15. So the problem is, I don't mitigate your point, but here's the drawback of Citizens you need to understand, and the membership needs to understand. And I'm not mitigating, we have to get that option for the association every year. Citizens doesn't cover water damage claims either. We need a wraparound policy, so you add another couple $100,000 to this situation. They don't call, it's a basic policy form. It's 4 wheels and an air conditioner, okay? So you have to add some tidbits to it that add
Sure.
up. But that being said, Citizens came out with 2 things they're highly publishing. One, they can assess you 45% of your premium you paid in if they're in the red. So based on your dissertation about the benefits of Citizens, they're saying, yeah, we'll take you, but if we have to assess you because we're going to be in the red with a major event like an Ian again, we're going to be in the red. We can assess you up to 45% of that premium. So that's circulating with all these boards about Citizens. They're worried about that 45% assessment issue because they're publicizing it now. They never did that before in 04, 05, or even Andrew, or even Irma. So that they're putting that out there. And then the second thing, which is more of a concern to myself, is they don't cover code upgrades. They don't cover code enforcement. Citizens does not cover that. Let me explain. So why these claims are so large, so you understand these hurricane claims, is what happens is if we get a Cat 3 hurricane here, Chris and I are going to be speaking. I'm like, Chris, you're going to have public adjusters going to be calling you left and right, okay? All the public adjuster needs with a structural engineer is to get 25% damage to each roof system. They're going to do 4 different engineering tests to that roof. They're going to get that 25% every time. They're going to do an uplift test, pressure test, moisture test. They're going to get that 25% every time. That's why Hurricane Wilma was $14 billion. That's why Irma was $30 billion. That's why roofclaim.com sends in drones everywhere. It's all about these roofing claims, okay? So Citizen says, we're taking that off the policy. We don't honor the 25% code. Well, you can't pull permits because you just can't patch it up when you hit that 25% burden. So Citizen says, well, we're only going to pay for what's damaged, not what's undamaged. So then you're in a contest of what's pre-existing, which is what the wind hit. But you can't pull permits unless you're 25%, when you hit that 25% moniker. So you're going to be, these Citizens claims, which are not what they were in 04, 05, where Citizens just wrote checks, they're going to clamp down and say, we don't have building ordinance coverage. We don't cover any code enforcement. So a lot of the memberships don't understand this. They're so focused on the number. You have full code coverage on this Lloyd's policy. You have roofs fully covered with any code scenario. And not just the roofs, the windows, the sliders you may have to go impact. You may have to hit the Florida building code. If 51% of one of these structures gets damaged, that's a total loss in Florida. They will tag it. And you have to go Florida building code and impact glass in all the units. This has happened in Delray after that hurricane. So we had a major tornado after Hurricane Ian in Delray, which is in Kings Point, which is one of my claims. It was $6 million. It was all codes. It was all 25% rule on roofs. It was all full concrete, no EFIS construction anymore, and full impact glass and sliders and windows. Citizens will not cover that.
And final question is, how did we estimate $700,000 for insurance and end up paying $1.3 million for
Because
insurance?
brokers like myself, even after 28 years of doing this, the full magnitude of Ian did not take hold the time that budget was done, with the reinsurers fully escaping this market, and we were all left holding the bag, which is what you're reading about. This is a crisis. So brokers like myself can't pinpoint, even though we've been doing this a very long time. I've been out of budget advice-wise for the last 3 years.
So basically, the ramifications of Ian hadn't come into effect at
Correct.
December
It takes about
1st,
18 months.
22. Okay, thank you very much.
No
That
problem.
was all I
Great
had.
questions. I get them frequently. Great questions.
So one thing that I want to reiterate with that is, remember, we do our budget in November. Our insurance doesn't renew until May, okay? So we guesstimate in November on going what percentage should we put in. We don't know the actual number until May, okay?
And keep in mind, I think Ian was October 24th, and you're doing a budget in November. Nobody knows what the hell's going to go from next May. So I apologize greatly, we were off. But everybody's been off, unfortunately.
Thank you. Damien, I'm Ed Blattberger. We
Hi.
talked.
Yes.
We were emailing back and forth briefly. I had actually contacted his office and spoke with Andrea for my own personal coverage in the condo, and just by chance it happened to be the same company of the commercial section, which is Damien. So she put me over to him, and we had some brief emails going back and forth. But yes, thanks for all the information. I hear a lot about Citizens and Lloyd's, and I think we're all aware that they're certainly on the higher side, and because they're one of the few that will insure certain properties. My question, though, is that, because I'm always being told roofs. I think our emails went back and forth talking about roofs, and it seems to be the big subject. I know when I was checking on our place, that came up from every insurer I called.
Yeah.
Some even said it's over 10 years is too old.
Right.
But most of them was over 15. So my thought is that if we got to a point where all of our roofs are 15 years or less, does that not open up other insurers besides Citizens and Lloyd's that might be more competitive?
There's two major markets that are not rated in Florida from an AM Best standpoint. They're called American Coastal and Heritage. Okay, these are two admitted markets in Florida. Remember we talked about non-admitted? These are admitted markets. A lot of the smaller companies are admitted because they need the state backing to survive and do policies in Florida. They have a Dematec rating, which the lenders will accept. But American Coastal and Heritage were definitely hanging by a respirator 6 months ago. They're both public companies. I think American Coastal stock's up to $7. Heritage is like $4.50 a share. But if they get one more pop, it's going to be tough for them to survive. But being said, to answer your question, if your roof's within a 15-year pocket, they'd struggle with the size of this property and the age of the property. But technically speaking, they would quote this. Now, would they be much cheaper than Lloyd's? No. They would be close to $2 rates. $2 on 60 million is 1.2 area plus. It wouldn't be a gift. And they would be not rated. So they can go into receivership. And then you have to go to the guarantee fund.
Well, then let's go backwards on that then. So if our roofs were less than 15 years old, would Lloyd's or Citizens be less than where we're at right now?
Citizens, obviously, we'd have to rate up based on your roofing variables. The Citizens rate right now on something like this is probably $1.40, which is about 14 grand a million. Remember I said historically we're at 5 grand a million? So 14 grand a million, plus you need a wraparound policy because they don't cover water damage claims. Plus you need to add an ordinance policy to cover that code issue enforcement. That's a big number. So long story short, we could wind up right back where we started. But just a Citizens quote on this thing would probably be around 800,000 to 900,000.
Okay. On your email, and maybe I misunderstood it, so I'm going to ask you here, is that there seemed to be a suggestion. I was trying to ask you about roofs of equal buildings. One building, just like ours, has roofs over 15 years old. Another building, just like ours, is less than 15 years old with the roofs. I thought I understood your email to say that would be about a 50% greater premium on the building that has the older roofs?
50%?
Yes,
Did I say 50?
yes.
It could,
50% higher.
it could be.
So is it possible that ours is right now 50% higher than what it could be if all the roofs were less than 15 years old? I'm just trying to do the math.
Yeah, I
overall.
mean, the time this renews in May, if the market softens up and that spread's there, yeah, it could be.
So it's possible our premiums could drop by 50% with all the roofs less than 50.
Not dropping, based on where the market is next
Okay.
year.
50% less than what it would be otherwise.
Correct.
Okay, that's where I was going with that. Thank you. And then just a basic on the math, you had mentioned, I like the math because the math may help our maintenance fees.
Right, right.
You know, that's what's ailing this
Right.
community right now is our high maintenance fees. It's kind of ripping us apart a little bit between us. If you've seen some of the recent meetings on YouTube.
Yeah, there's not to interrupt you, but I do a ton of villages with this amount of membership. It's extremely common.
Yeah, and it's
Extremely common.
Our YouTube meetings the ratings are going up, and I think we just
Yeah,
passed
so
Barbie.
you're-
I think we
you're not
just
in the
passed
minority.
Barbie last
You're not in the
week.
minority here.
But the 2,500 a door you had mentioned, the math I got on it was a little bit at 510 units with the amount of insurance we're paying. I came up with 3,774.
That's for the total. I'm just talking the property piece.
Okay.
Just the property, just the Lloyd's of London, the $1.3 million policy.
Okay, so I presume going forward there is some conversation you can have with our association and our managers regarding how the next premium can be gotten down less?
Well, it just all depends on market conditions, right? So
Well-
we're getting out of hurricane season. You're doing roofs are staggered. We hope 24 brings some light. Okay, interest rates, elections, money flows, reinsurers. So hopefully things go in a good fashion, cup half full approach, that we can get this number down, at least state, we told you to budget 35%. Maybe we don't need the 35%.
Well, again, just hypothetical, let's presume market conditions stay exactly the same. So if we got, again, I'm just making sure I understand this.
Right.
If market conditions stayed exactly the same, and we worked here to get all our roofs down less than 15 years old, which I understand is 20 roofs times 50 grand, so it's $1 million.
Well, the market conditions, in terms of staying the same.
Well, no, my question to
I
you, though.
prefaced earlier that we're still in a rough market for next year, hence the 35%.
Okay, but
comment.
here's my question to you, though. Make sure I understand what you're saying correctly.
Mm-hmm.
If the market conditions did stay the same, and we locked all of our roofs down where they're less than 15 years old, which we were told there's 20 left at 50 grand apiece,
No, you have some
52
in
grand.
06, 07.
so it's $1 million.
You have
so-
some roof dates in 06, 07 as well.
Okay, so is it 20 roofs we got left?
There's 8 that are still due now that'll be finished this year. There are 11 that are in 2025. And then all the other roofs that were done have been done longer than 15 years.
Right.
So you've got the 20 that are being done now, so there's 31 roofs that would need to be replaced.
Right.
So 31 times $52,000.
So we got 31 times 52,000, so it's $1.5 million, 6, whatever it is.
Right.
So again, so if things stayed exactly the same and we dropped 50%, because now all our roofs, I'm just trying to do this math.
Right.
All the roofs are less than 15 years old at that point, that would drop by about 50%.
Right. Nothing, let me answer it this way. Nothing is going to drop the premiums next year. If you did all your roofs tomorrow and spent the $1.5 million, because the market sets every year with different reinsurance contracts, the market is supposed to go up another 20 to 40% next year. So if you roofed all day yesterday and Chris was out here with a SWAT team of roofers, you'd be lucky to stay where you're at now.
But what if we didn't change the roofs? So the roofs do stay over 15 years old, is that not going to keep going up then?
Hence the 35% comment, but that's market conditions, Ed. So hopefully, I was telling Chris earlier, I predict probably we kind of stay within a 10, 15% range next year with the same product with Lloyd's. That would be a win as you staggered and continue to do these roofs. And maybe the market, so what the market's supposed to do, it's supposed to go one more year of pain, it's supposed to level off, and then it starts to drop. That's what everybody's predicting in the insurance world. So what you're trying to set the table and doing those roofs in 24 months, so when the market softs, this thing starts to really drop. Because DeSantis just signed those measures to stop suing insurance companies. It's going to be very hard for those claims totals to be what they are right now.
Yeah, I appreciate it, but again, I'm going to leave that to you guys. The insurance industry, you guys can figure out that stuff. I'm not trying to predict the insurance industry. I'm just trying to contribute.
Right.
As an
I
owner
appreciate that.
here, towards making sure, not that the board isn't, I give them credit, they've been
Right.
working hard at it. I'm not
Right.
suggesting anything otherwise.
Right.
I'm just trying to come up with ideas myself based on the calls I've made, as how whatever the future holds for the Florida insurance industry, that we're doing as much as we can here to get the lowest possible premium.
Right. No, I appreciate
based on
that. No, it's.
That's what I'm after.
No, and that's yeoman's work there. Appreciate
Okay,
that.
so I
The-
appreciate
the-
you coming, but that's where I was going
Absolutely.
with it.
The other problem we have is not a problem, is these properties are being worth more every 3 years. So that 58 million is going to become 65 million. And when this thing renews, it's a rate times a value. So all these variables, you're trying to keep a pocket. But best case scenario, you did all these roofs tomorrow, you'd be at $2,250 a door versus $2,600 a door. That's what we're talking about here on 510 units. And I don't know where you're going to live in Florida for less than $2,500 a door for common area assessment insurance for a condo
How much
association.
savings?
Century Village and Kings Point are paying more than that.
So the 50% premium, that was inaccurate. The 50%
It's aggressive.
lower. premium.
It's aggressive.
Okay.
It's aggressive.
All right, thank you.
Jim Hensel, 12J.
Like your hat. like
Got
your
a
hat.
question for you. If I owned an insurance company, I'd be awfully unhappy or concerned if I had to insure large areas in any one particular place. One hurricane, say a Category 5 through here, 60 million bucks gone out the window.
Right.
Is it possible to take our association, say we have 51 buildings, and split those buildings between, say, 3 different insurance companies?
Yeah.
And get a lower maybe price?
Yeah, the market doesn't work that way. You would think they would get creative like that, but it's one insurable interest, it's one condominium association, I believe, right, Chris? It's one legal entity? Correct. Okay, yeah. So if you were separate legal entities per each building, and some, had great roof dates, and some didn't, and some had this, some had that, some had impact glass, some didn't. Theoretically speaking, yes, there'd be a benefit to that. But obviously that's not the case. You're one legal entity. So that's impossible.
Other question, you said that it's possible that next year's rates might be lower. But our budget's made and we're going to be paying for the insurance
Right.
Escrow at those rates all year. We'll end up, in that case, with a little extra money in the escrow.
Yeah.
What do we pay for interest rates for making monthly payments
Yeah.
instead of a,
See, some boards are so sick of budgeting increases on this line item. I've had some boards take insurance right out of the budget. I've had some boards do a hybrid strategy where they're saying, listen, we're just going to pick 20%. If we're off, Damien, we're just going to assess for the difference. Hit you all with $400 each. So because we don't want to raise these dues too high, that it's not real estate sustainable or attractive per se. So there's all these financial approaches in this hardship, which everybody's trying to think outside the box like you are in terms of 3 different insurance companies. Everybody's trying to think outside the box, but we're trying not to be off. But I think based on where you're at with the continued roof work, plus, lack of hurricane season this year being of magnitude, I think we're going to be less than the 35% number, yes.
Jim, just to answer your actual question, I think we financed about 671.
I'm
No,
sorry.
we financed about $671,000, and it cost us $21 in interest and fees.
Thank you, Chris, because you always,
That was this,
dollars or percent?
$21,000.
21,000.
Yeah,
For financing how much?
671,000.
it's amortized, but that's,
I was just wondering if it's beneficial to leave any excess money in the escrow account to make larger payments in the future.
yeah, you're all about cash flow.
Damien, what we did at one point, we have what Jim is calling an escrow account, where we fund an account. And up until last year, we were able to pay our insurance off.
That's right.
Cash. We wrote one check and
I
paid it.
forgot about that, I apologize.
Okay?
Yeah.
So once this has jumped to this much,
Yeah.
we'll save about half of the 1.3 million, not even
Got it.
half of the 1.8.
Got
So
it.
we will have to finance the rest of it.
The differential.
So I think we're trying to say, how much money can we keep in there that we can
Right.
keep building up?
Right.
But at 1.8 million,
Yeah, it's too big of a
unless
spread.
you want to special assess everybody to put a big lump in there.
Yeah,
It's
sorry.
No, I meant, we could still, if there's any reduction at all, keep the money flowing into the,
So eventually we can pay
instead
it,
of reducing our.
correct, so eventually we can pay it in cash again and have no finance charges, nothing like that.
The interest would work.
Right.
Hi, Judy Roberts,
Hi,
17G. Kind of a question, I guess, for Chris and you as well. You've mentioned a couple times now about special assessment, but I believe I've heard in the past, Chris, correct me if I'm wrong, that we can't special assess for the insurance premiums. I was just thinking if we can relook at the budget and hope that maybe it's not going to be as high as the 35%, which is maybe what he's saying, can we reduce the amount of monthly maintenance, and then come May, when we know what the insurance number is going to look like, special assess for maybe anything that was a difference there?
Did everybody understand that question? Okay, so what we can do is, let's say we only put 20% in, and it comes in at 30. We can special assess that difference. We don't have to increase the budget that year. Last year, it was so high that they amended the budget, if you remember. What we can do is special assess that difference, but then the next year, that difference has to be into that year's budget. Then you put another 20% in. So you get away with it for 1 year. That's it. The very next year, you have to put that in because it's a known operating expense. But you can always special assess the difference. Correct?
Yeah, it's not uncommon.
Yeah.
No.
So, I mean, if the board wanted to lower it and say, okay, we're not going to put in 35%, we're only going to put in 20, the difference would have to be special assessed. It would be added into 2025 then, and then another 20%, and so on and so on. So you really only get away with it that 1 year, because you have to increase it for the next year.
Along those same lines, since that's our largest expenditure, right?
Yes.
And it fluctuates so much, why don't we change our fiscal year until, say, May or June?
Well, that's already been brought up about a year ago, and it is something that the board is still looking into. So what that would do is we would change our fiscal year to July 1st to June 31st, so then we wouldn't be guessing at what it might go up to. Any other questions for Damien?
Eventually we're going to go down. Like, that's all I can say. Eventually we're going to go down.
I don't care how you do it. We need a lifeline here. Our HOA went up a lot. People are trying to sell. If somebody needs to get a mortgage to buy that unit, they're not going to be able to. Therefore, because there's no, what insurance company is going to insure them? So whether it be the insurance or the budget, we need to lower it and give us a lifeline.
Okay, so right now, nobody can get a mortgage, and the reason for that is because we're not 100% insured, and no insurance companies will insure us for the entire amount. Okay? So lowering the actual insurance rate or whatever we can do that way is not going to make anybody be able to get a mortgage because we are not insured for the full $58 million. Is that correct, Damien?
Currently with the staggered roof approach.
The way that it is now.
The staggered roof
Correct.
approach, yeah.
That's okay. I need the exercise.
But I think you just skipped over the meat of that question, Chris. She says we need a lifeline. Part of the problem we have with selling condos now is they have to disclose that our HOAs are going up. So imagine I'm buying a place for, $170,000. I find out the HOAs are 902, when I could buy a place down the road for $170,000 and the HOAs are $650. Guess which one I'm going to buy, right? So not only is this high insurance rate hurting us as far as what we have to pay for our monthlies, it's reducing the value of our properties. So wouldn't that eventually make us get assessed for less? Or do they just say, oh, you're worth $180,000 a unit, and it's just sweeping like that? The thing that I think I see, I keep hearing all these things, but if we go with these admitted companies, American Heritage and Heritage, we'd be at 1.2 million. If we end up going with Citizens, even with the wraparound coverage, we'd be at, let's say, $1 million. That's still $800,000 less than what we're paying this year. I mean, that's a big chunk of change.
I can't answer that question. And I don't think that's exactly what Damien said either. You keep saying that Citizens is 50% less. That's not what he said. No, he never said that Citizens would only charge us $900,000. I never heard that said.
They asked me, Chris, what it would rate up to, basically, and I said you need a wraparound and a building ordinance policy, but the basic Citizens piece would be around $900,000.
And how much would a wraparound?
About $200,000.
All right, so we're already...
But the code coverage is the concern. There's a separate policy for that. You could forgo it, but that's another $300,000-400,000 because that's where all the claims are. But if we say, you know what, the hell with the code coverage, we'll just take our chances on what's damaged and just deal with Citizens, yes, you'd be around that $1.2 million, $1.1 million pocket with the Citizens scenario.
So there's two scenarios basically where we could cut back $600,000.
But you're going to have to get all the roofs done, for sure. You're going to have to get all the roofs done because of that 15-year plus area roof rule. you're going to have to get them all done the time this thing renews on May 10th.
And what is the requirement for a roof to be considered new?
That's,
Covered or it's got to be rebuilt?
yeah, I'm not a roofer to that effect. You know, the insurance companies don't, even Citizens don't like, I know this is not a flat concrete deck roof. They don't like silicone coatings or anything of that nature. I'm not saying that's what you're talking about, but they don't kind of like a cursory, just, you know, replace the tile. They want to see some underlayment. They want to see a check written that's pretty healthy to do the roofs. I'm just not. Correct, correct. I'm not a roofer. Yeah, I'm not a roofer per se, but the magnitude of the roofing, I don't know. I'm obviously don't see your roofing contracts. But obviously, if there's a permit involved, and let's say it's, you know, Chris says there's 50 some odd thousand, that's a healthy number, but we can get through Citizens.
So when you say code also, so if one of our buildings is, they say it received enough damage, so what they have to do is come in, they have to do, all the windows would be impact, all of them, even your sliders. All the doors would have to be made impact. We don't have sprinkler systems. We don't have fire alarms. We don't have any of that stuff. So what he's talking about, a code upgrade, if your building was condemned, all of that stuff has to be done.
It triggers the
Citizens does not ensure that.
It triggers the Florida Building Code. Citizens will not
Correct.
cover those upgrades, yeah.
One other thing I wanted to say, Lou, you think that because the values, the prices are coming down, it doesn't have anything to do with prices coming down. It's the replacement cost of the building. Am I right?
Correct.
Okay. When you replace, you got to insure for what it's going to cost you to replace it. It has nothing to do with what you sell it for. If they're going for $50,000 and it's worth $100,000 somewhere else, it doesn't make any difference. And, you know, and one of the things is, you know, I mean, you mentioned $563,000 on the insurance the previous year. It came in at $593,000. Okay, we added 20% to that. We had 20% every year. Always covered us, the 20%. And we paid, and correct me if I'm wrong, Jim, we paid this thing up front all the time. After that, it went up 127% from that $593,000. There's nothing we can do about that. I mean, obviously, if you're listening to Damien, you can't do anything about it. It is what it is. The market's the market. I mean, I'm sure this board does not want these premiums or anything going up, or HOA fees or anything going up like they are. I mean, everybody's trying to keep it under control, but it is what it is.
Okay, maybe one more question.
One more question.
Look who it is.
Yeah. When we're talking about insurance and what these companies cover, we have a deductible, don't we?
Correct.
And how much is that deductible per building?
5% per building.
It's about $27,000.
5%.
So we're self-insured, more or less, $27,000 per building
Correct.
if we have a wipeout. That's a lot of money.
Well, keep in mind, every homeowner's policy has $2,000 of loss assessment per unit. That would aid in that.
We just had liability.
So with 510 units, assuming everybody had insurance,
Can we just get?
you get $2,000 from your homeowner's carrier. So that's $1 million right there. So that would help into that
We
situation.
don't live here, they said.
It's called loss assessment coverage.
You yourself?
Yes.
Yes, you can.
But again, just to finish this, I mean, just doing this all day, every day, I haven't seen an association under $2,250 a door for property insurance anywhere. Just to give you perspective, you're at $2,600 right now. So obviously, our goal is to keep that right there. It's a really tight pocket. And then hopefully this thing kind of cooperates, and then we can get, you know, you're going to stagger your roofs over the next couple of years. You'll be fully buttoned up. We'll do new roof inspection reports. We'll keep trying the citizen angle, and the open market should develop at that point. And I can come to you with some other products. We're the largest broker. We have all the markets, albeit extremely limited right now. But rest assured, doing this all day, every day, you're gonna, as soon as something pop up, you're going to know about it. Okay? Okay. Thank you. Appreciate it. Thanks.